Welcome back. In today's video, we're going to be unlocking the secrets behind draw and liquidity. You guys will understand stop hunts, imbalances, and the draw during expanding markets with this draw and liquidity checklist here, and as well as the notes in the video. As you see, the draw and liquidity checklist has a lot on it, but don't overanalyze, don't get analysis paralysis. All of these things perfectly mesh together once you understand each and every single thing to its core. Right, with draw and liquidity, we always look at the previous day's close. Is it high, low, or inside? We always need to understand our internal to external liquidity and how this pairs higher time frame and lower time frame. We need to understand, are we running against low resistance liquidity or high resistance liquidity? Do we have equal highs or lows? Where's our market structure? What is our market structure looking like? We need to understand where our key highs and lows are. And I understand that a part of draw and liquidity are these key highs and lows, and we will understand how equal highs and lows. We will understand how low resistance and high resistance are key highs and lows, and understand how we can follow order flow from the turtle soup sequence to be able to find the real draw and liquidity versus a manipulation target. We understand our power of 3 open low high close and open low high close. We will always look for failed PD arrays, and that comes with our order flow. Failed high time frame PD arrays are usually signatures in price. We also look for an SMT divergence, and all of this is going to be high time frame into low time frame, as well as market makers buy and sell models. You can look at DXY. I don't as much now, but obviously, do we have news on the day? Power of 3, our weekly profile into where midnight open is, the daily profile, equilibrium, OTE, and then as well as a top-down analysis. Let's get straight into the chart, understand each of these concepts, and not allow ourselves to get manipulated inside of the market. Now that we have a rough outline, we need to understand how we can mesh everything and pair each of these items together and understand liquidity. For number one, we need to identify where liquidity pools are resting and look for areas where stop orders, aka liquidity, is likely resting. These areas include old highs and lows, which is swing highs and lows where retail traders place stop, equal highs and lows, right, double tops and bottoms, right, above and below consolidation ranges, right, in very strong liquidity pools are like previous day high, previous day low, right, previous week high, previous week low, even previous month high, previous month low. For number two, we're always going to be using a higher time frame analysis and using our high time frame draw and liquidity. We use a top-down approach using the weekly to daily to identify key swing highs and lows. Obvious fair value gaps are where we have obvious imbalances that need to be balanced. If price is trending higher, we look for liquidity above old highs, and if price is trending lower, we look for liquidity below old lows. In both situations, in most situations, we will have liquidity in both directions, but for how we trade, we look for one end of the range, right? If we're bullish, we look for the sell side liquidity to be taken out and then a run onto the buy side. If we're bearish, we look for a run on the buy side into the sell side. Let's look at how that looks right now. Looking just on the daily chart, we can see in a situation like this, we have relative equal lows, and we have a big thick down closure run on the sell side liquidity, and then followed by a distribution towards the buy side. Right, we can see that one more time here after a reconsolidation, a big break lower, sweeping out swing lows with low resistance liquidity into an order block here, resting also inside of a fair value gap. You can see after that reconsolidation, right, building liquidity on the buy side and the sell side, we have our big thick run lower, followed by a closure, right, a indecisive candle on the daily, followed by then closing above, right, forming a CSID order block and being able to enter there and ride until the until the opposing end of the range, right, until our buy side liquidity. Often in an expanding market, when we run above these highs and it's at an all-time highs, people have a fear of longing into where they never have seen price, and in a situation like this, I tell you, we just see our reaction above our key high, see how we react, and if we don't react bearishly above the key high, right, reactively and very expressively, then, right, from an accumulation, manipulation, distribution standpoint, there's no reason that we should stop just at the high. We can see, then we come to our higher time frame chart, and what do we notice, right? We leave a weekly fair value gap after, right, reaccumulating on the daily chart above our old high. So on an internal to external standpoint, we should use this fair value gap with previous down closure candles to support price to the external above previous day high. If we look on the daily chart as well, we notice that we have a very indecisive candle. Like we talked about, this is an accumulation range candle where we form both buy side liquidity and sell side liquidity, right? If we look on the weekly, right, leaving that previous week high liquidity with a close above our previous week highs liquidity. So we look on the daily, we see that liquidity above, we see a thick down closure candle, or excuse me, we see a reaccumulation above, right? And what do? We sweep our lows very aggressively, right? Close back inside of the range, use our previous week's fair value gap to then support price from a internal to an external standpoint. We then see our close above, right? Also a daily VI. So from a swing standpoint, you're able to note that you have a draw on liquidity, previous week's high, and you shouldn't need to run this high. I mean this low, right? And then we run the high very aggressively, because what do we also notice? And we also see if we bring back just a couple 4-hour candles on that Tuesday after delivering from the order block, that internal to from that internal move to the order block, we can see we leave low resistance highs into more low resistance highs into relative equal highs and a failure swing. So we have low resistance liquidity all above. We are entering a weekly internal, rejecting the weekly internal, forming an order block inside of our weekly wick, right? And then delivering higher from said rejection block inside the lower time frame order block, right? Then we go even lower time frame. We can see we're inside of, right, this order block here. Mark it out. Come into an equilibrium, right? And even, if I put this on a 2-hour, right? Well, let's throw it on like a 30-minute. Right? Big thick down closure, right? We can even find a lower time frame order block in there. We can see that we even tap into that, sweep an internal liquidity from our previous lunch session, an anticipated failure swing right inside of here on the higher time frame, right, due to a time-based liquidity during Tuesday with our open low, then into our high close on the weekly. We then go to a lower time frame, right, that we then reaccumulate and have no need to sweep the lows because the damage has been done delivering into an OTE, and we have these failure swings. We have previous day high liquidity, right? And even into, right, where I just said we have no need to go lower, we have Asia highs liquidity, right, with low resistance liquidity. So an even, right, more high probability time-based liquidity, previous day high, Asian sessions liquidity into our market structure and seeing what time we're delivering to the high. You can see how this aligns with high time frame PD arrays, right? The draw on liquidity often aligning with order blocks. FEGs are breakers on the higher time frame, right? Price will seek to fill inefficiencies, imbalances, and gaps. We see that fair value gaps use price and magnetize to open imbalances and they're created during displacement. We also understand that breakaway gaps can be used and we don't need to retrace to the fair value gap, right? We have an understanding of internal to external order blocks, right? Accumulation, manipulation, distribution, all of the things on the draw on liquidity checklist, and they add all in to almost create a symphony like music so you can be able to navigate price confidently, correctly, and precisely. I made sure to note our time and delivery, aligning liquidity sweeps with certain time-based manipulations for Asian session to form a range and London session to manipulate and New York session to expand towards the liquidity. Oftentimes, if the damage is done during one session, then the next session won't need to manipulate. On a higher time frame, if the damage is done, the next week won't have to manipulate. That's why in that one example, I didn't need to manipulate past the previous week low, because a high time frame order block had been set into place inside of our internal fair value gap on the weekly, which then delivered a rejection block, which then delivered an order block into our market maker buy model, which then finished off into the buy side liquidity. Number 5 comes in with their institutional order flow, and we observe the direction and price respecting or violating PDAs. And for our scenario and understanding turtle soup, that's why I showed you guys us running one side of the liquidity in multiple scenarios before then distributing to the other end of the range. Right, if we're bullish, we'll have big thick down closure candles to then manipulate lower and distribute higher. Then, as you saw in our examples, we then have a drawn liquidity confirmation, which we use our confluences for precision. We use SMT divergences, order blocks, the optimal trade entry, and to change and stay a delivery to find our displacement inside of our key level, to then find where our true drawn liquidity is after the manipulation, and not getting psyched out by the big thick down closures and thinking we're bearish.